We've also had the recent announcement of Chinese insurers being allowed to invest in gold. Is that going to be a new big source of demand going forward here?
I think it'll be a source. I think that if they were legally prevented from owning gold, gold's been a very good performing asset. Mm-hmm. It's actually beaten the stock market over the past 25 years or so. Mm-hmm. It's up 10x. The Dow's not up 10x over that time period. So, it's done well. And so I think it's a good portfolio insurance. It's something that I think if you add it to your portfolio, it reduces the overall risk of the portfolio. So insurance companies would probably want to have some gold in their portfolio. So sure, I think, they're, as a new buyer, it will, obviously at the margin impact the price. I don't know how much they're going to buy, but I do believe that over time, a lot of institutions that are not buying gold will start buying it. I mean, the reason that gold has gone up is because central banks have been buying. The public has been selling, especially in the US and Western Europe. Maybe in China and India, they're probably still buying. But Americans are selling their gold. We had net outflows all year last year in GLD. We had net outflows in all the gold ETFs, GDX, GDXJ. We've had a pickup in net outflows of, not outflows, but redemption sales at Schiff Gold. We're getting a lot more people than we used to calling up and selling us their gold. Hey, gold's $2,900. Hey, let me sell some. I can use the money. Mm-hmm. We're not getting a big increase in people saying, oh my God, gold's $2,900. Let me buy it before it goes even higher, right? We're not getting the, oh my God, I got to buy. I'm afraid to miss out on more gains. I better sell while I can before the price goes down. So we don't have any kind of speculative fever surrounding gold mining stocks. It's the opposite. So it's the central banks that have been buying. That's one of the reasons that the gold silver ratio, I think, is 90-1, because the central banks don't buy silver. They don't have the room to store it. I mean, that's not what they want. They want gold. It's generally the public that buys silver. And so when the public wakes up to the real inflation threat, and when they realize that they've been sold a bill of goods with Bitcoin and other cryptos, they're going to be looking for gold and silver. And there's not a lot of it. The supply, especially with the central banks buying gold, but there's not a lot of silver out there. So I expect prices to go much, much higher when the Americans and the Europeans wake up to reality. And the reality they're going to wake up to is stagflation, and that, inflation is here to stay. Inflation is not going anywhere. The central banks spent over a decade deliberately creating inflation as a policy choice. That was their goal. Quantitative easing is just a euphemism for inflation. They said we need higher inflation, and we're going to print more money. We're going to let governments go deeper into debt. And I kept saying, you be careful what you wish for, because you're going to get a lot more inflation than you bargained for. And there's no way you're going to be able to stop it, right? You're not going to be able to turn the spigot off. And so that's where we are. This is going to be the most inflationary period of time that the United States, Europe, PAM have ever seen. It's going to be way worse than the 1970s, because we were in a position in 1980 to put the brakes on inflation, because we had Ronald Reagan, we had Paul Volcker, we jacked interest rates up to 20%. 20%. Now, the highest inflation ever got on the CPI was 13, yet we had 20% rate. So this cycle, we had inflation go to 9, and the highest we got was 5.25. Clearly not enough, right?
In a landmark decision, China has initiated a pilot program permitting 10 major insurance companies, including industry giants like PICC Property and Casualty Commercial and China Life Insurance Co., to allocate up to 1% of their assets into gold bullion investments. This policy change, effective from February 2025, translates to a potential influx of approximately 200 billion yuan, around $27.4 billion, into the gold market, according to Minsheng Securities. This strategic move underscores a broader trend among institutional investors seeking diversification and stability amidst global economic uncertainties. Historically, Chinese insurers were restricted to assets with stable cash returns, such as bonds and equities. The inclusion of gold, a non-yielding asset, signifies a paradigm shift in investment strategies, acknowledging gold's role as a hedge against inflation and currency fluctuations. The authorization for Chinese insurers to invest in gold introduces a substantial new source of demand in the global market. Given China's status as both the largest consumer and producer of gold, this policy could further tighten supply dynamics, potentially driving prices higher. Analysts anticipate that this development, coupled with ongoing central bank purchases, could propel gold prices beyond the $3,000 per ounce threshold in the near future. Renowned economist and financial commentator Peter Schiff has long advocated for the inclusion of precious metals, particularly gold and silver, in investment portfolios. Schiff emphasizes that gold has outperformed major stock indices over extended periods, highlighting its efficacy as a long-term store of value. He notes that while the Dow Jones Industrial Average has experienced significant growth, gold's appreciation over the past 25 years has been even more pronounced, underscoring its resilience and appeal to investors seeking wealth preservation. Schiff also points out that central banks have been net buyers of gold, a trend that reflects concerns over fiat currency stability and geopolitical risks. This institutional demand, he argues, is a testament to gold's enduring value and its critical role in diversified investment strategies. An intriguing aspect of the precious metals market is the gold-silver ratio, which measures the relative value of gold to silver. As of early 2025, this ratio stands at approximately 90-to-1, indicating that it takes 90 ounces of silver to equal the value of 1 ounce of gold. Historically, this ratio has fluctuated, but such a high level suggests that silver may be undervalued relative to gold. Peter Schiff recommends that investors consider allocating about 2/3 of their precious metals holdings to gold and 1/3 to silver. This allocation strategy leverages gold's stability and silver's potential for higher returns, especially if the gold-silver ratio reverts to historical norms. Despite the bullish indicators for gold and silver, retail investor sentiment, particularly in Western markets, appears subdued. Schiff observes that many American investors have been liquidating their gold holdings, possibly to capitalize on recent price increases or to reallocate assets. This trend contrasts with the behavior of central banks and institutional investors who are accumulating gold as a safeguard against economic volatility. This divergence in behavior presents a potential opportunity for astute investors. As public awareness of inflationary pressures and currency devaluation grows, there could be a resurgence in retail demand for precious metals, further supporting price appreciation. The global economy is experiencing heightened inflationary pressures, reminiscent of the stagflation era of the 1970s. Central banks, after years of accommodative monetary policies and quantitative easing, face challenges in curbing inflation without triggering significant economic slowdowns. The current economic environment differs markedly from the early 1980s, when policymakers successfully combated inflation with high interest rates. Today, elevated debt levels and lower tolerance for economic contraction limit the effectiveness of traditional monetary tightening measures. Schiff warns that the inability to implement aggressive anti-inflation policies could lead to sustained inflation, eroding purchasing power, and undermining economic stability. In such scenarios, assets like gold and silver, which historically maintain value amidst inflation, become increasingly attractive to investors.
So we didn't do what they did, and they brought about the worst recession since the Great Depression in the early 1980s. But when they did this, when they went on this inflation fight, debt to GDP was 30%, not 120%. The average maturity on the national debt was probably at least 20 years, not 4 years. The U.S. is still the world's biggest creditor nation, not the biggest debtor. We were still running trade surplus in 1980, not massive trade deficits. So we are not in a position to survive the inflation fight the way we did in 1980. So we were in a position and we had the ability to end it. And the stock market in 1980, the Dow was what, 7-8 times earnings? I think the dividend yield maybe was 6% or something. I mean, the stock market was cheap. The Dow was under 1,000. The price of gold was 1,000. I mean, the gold and the Dow were the same price, right? I mean, you talk about cheap, right? I mean, it was as cheap as stocks were at the bottom of 1932. After the market crash. So we had cheap stocks. We had, interest rates were 13% on a 10-year treasury. So we were in the opposite position that we're in today. We have no ability to wage a winning war against inflation. That's why we surrendered already. That's why the Fed started cutting, because 5.25% was too much to bear. So inflation is not going to end. It's just going to get worse and worse and worse. The only thing that could save us, I guess, would be AI and a massive productivity boom that, could eventually bail us out.
The global financial system is undergoing a profound transformation, and gold and silver are at the center of this shift. As economic uncertainty increases, More individuals, institutions, and central banks are turning to precious metals to preserve their wealth. This growing demand is not merely a reaction to short-term market volatility, it is a recognition that the fiat currency system is becoming increasingly unstable. Governments have spent decades printing money, accumulating debt, and artificially manipulating interest rates. As a result, inflation has become a structural issue rather than a temporary concern, with debt levels at historic highs and central banks unable to implement aggressive anti-inflation measures without crashing financial markets. Gold and silver are emerging as essential assets in an uncertain economic environment. One of the most significant drivers of this shift is the inability of central banks to effectively control inflation. In the 1970s and early 1980s, the Federal Reserve, led by Paul Volcker, was able to tame inflation by raising interest rates to unprecedented levels. However, the economic conditions today are vastly different. In 1980, U.S. debt to GDP was approximately 30%, meaning that the government could afford higher interest rates without facing a debt crisis. Today, with a national debt exceeding $34 trillion and a debt to GDP ratio surpassing 120%, raising interest rates to historical levels would lead to a financial catastrophe. The Federal Reserve has already demonstrated that it cannot fight inflation in the way it did decades ago, as recent rate hikes have been modest compared to the inflationary pressures facing the economy. This failure to act decisively has led to a loss of confidence in fiat currencies, pushing more investors toward gold and silver as stores of value. Another key factor in gold's rising demand is the increasing accumulation of bullion by central banks. Over the past few years, countries like China, Russia, and India have significantly increased their gold reserves as part of a broader strategy to reduce their reliance on the US dollar. The growing use of economic sanctions as a foreign policy tool has accelerated this trend. Nations targeted by US-led sanctions, such as Russia and Iran, have sought alternatives to the dollar-based financial system, using gold as a means to preserve economic stability. This de-dollarization effort is reshaping global trade as more countries are moving toward gold-backed transactions and alternative currency arrangements. The BRICS nations, Brazil, Russia, India, China, and South Africa, have even discussed the possibility of introducing a gold-backed trade currency, which, if implemented, could further weaken the dollar's dominance in global commerce. While gold is attracting institutional and sovereign demand, silver is also gaining attention, particularly for its industrial applications. Unlike gold, which is primarily held as a monetary asset, silver is an essential component in renewable energy technologies, electric vehicles, and advanced electronics. The global push for clean energy and technological advancements has created a surge in demand for silver, yet its current price remains significantly undervalued relative to gold. The gold-to-silver ratio, which measures the relative value of the two metals, is currently above 80-to-1, historically high and indicative of silver's potential for strong price appreciation. This suggests that as industrial demand for silver increases, its price could rise substantially, making it an attractive investment for those looking to diversify their holdings. As confidence in fiat currencies declines, discussions about a potential global monetary reset are gaining momentum. Throughout history, monetary systems have evolved in cycles, shifting between fiat currency regimes and commodity-backed money. The increasing distrust in central banks and their ability to manage economic stability has led many analysts to speculate that a return to some form of gold-backed financial system could be on the horizon. While a full-scale return to the gold standard remains unlikely due to political resistance, we may see a hybrid model where gold plays a more prominent role in trade settlements and currency stabilization. Central banks' continued gold accumulation supports this thesis, indicating that the financial system is already moving in that direction. For individual investors, the key question is how to position themselves for these macroeconomic shifts. The first and most important step is to prioritize physical ownership of gold and silver over paper-based investments like ETFs and futures contracts, which carry counterparty risks. During times of economic crisis, physical bullion provides a level of security that cannot be replicated by financial derivatives. Additionally, investors should consider diversifying their storage locations. Holding precious metals in multiple jurisdictions, especially in countries with strong legal protections for private ownership, provides a safeguard against potential government interventions. Switzerland, Singapore, and the Cayman Islands are among the top choices for secure offshore storage. Another essential strategy is to include silver in one's portfolio, given its rising industrial demand and historical undervaluation. While gold is a long-term store of value, silver offers significant upside potential due to its broader utility in technology and manufacturing. By maintaining a balanced allocation between gold and silver, investors can optimize their exposure to both monetary and industrial trends. The ongoing liquidity crisis in the gold market is not merely a short-term event. It is a reflection of deeper structural weaknesses in the global financial system. The era of fiat money dominance is coming under increasing pressure, and precious metals are reclaiming their role as foundational assets for wealth preservation. Those who take proactive steps to secure their wealth in gold and silver will be in the best position to navigate the coming economic challenges. As governments continue to print money, inflation continues to erode purchasing power, and trust in central banks diminishes, the demand for gold and silver will only increase. The most important takeaway for investors is that the transition away from fiat currency is already happening. Central banks are stockpiling gold at record levels, nations are exploring alternative trade settlements backed by commodities, and individuals are recognizing the importance of owning tangible assets. The opportunity to buy gold and silver at reasonable prices is quickly diminishing, and those who act now will be the ones who thrive in the new economic landscape. Gold and silver are not relics of the past. They are the future of financial stability. In an era of excessive money printing, rising debt, and weakening currencies, they provide the security and reliability that fiat money cannot. The coming years will be defined by economic turbulence, and those who are prepared will be able to protect and grow their wealth. The time to act is now. Stay informed, stay prepared, and as always, keep stacking.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.